Hey guys, it's Tucker Yielding with Mastermind Trading, and in this video, I'm going to be showing you how to essentially manage your account price-wise. And towards the end of the video, I'm going to be showing you how to take less losses percentage-wise and still be able to grow your account, even if you lose 3 trades in a row and still come out on top after running only one. So here, as you can see, and we're looking at a chart here, and the left side is going to be how much you use in your account. Second column is going to be how much percentage of you're going to be going in one trade of your account. Third is to be how much monetary value each trade is going to be. And then this is stuff you really don't have to worry about, mainly just the percentages, price of how much you're getting in for, and the total amount of your account. Here you can see $500, which is to be 100% of your account per trade. And that's, you can't really get by that with that small of account. With a $1,000 account, you can get a little bit better. Percentage wise, you can get 50 to 75% of your total account. $1,000 to $1,500 is where I recommend to start trading, just so you can take a couple losses with the rule I'm about to teach you here in a little bit, which will allow you to take some losses, like I said, some losses, and still come on top off of just one win. And this is exactly how I've been building my wealth for the past 3 years. Anyways, back to the video. We're going to be looking at the $1,500 total account value, which is going to be 33.33% of your account per play for $500, which will let you do 3 plays of 2 contracts. And you can just go down, and I'm just going to kind of skip it instead of taking so much time off this one. You can see $500 will be 25% of your account. And as you can see, they're still investing the exact same amount, but the percentage of your account will go down. So at $5,000, if you take a 10% loss, it's only affecting your account by 1%. Not if you take a 10% loss up here, it'll affect your account by 10%. So what you can see here is they're making it to where if they lose a trade, it's not affecting their account value by much, but they're still going to be growing significantly over time. This is exactly how traders are going to be building their wealth over time successfully, rather than blowing accounts up, which I'm sure that's why you're watching this video, because you're struggling with that. Now this is where you see a difference. $10,000 account, you're going to be seeing a 7.50% total of their account value going into plays, but you can see an increase into the amount of money they're putting into the trades, which is $750. Then so on and so forth. I'm going to kind of skip it because it's not too important when you get this big account, because by then you should know how to manage your risk. 20K, 5%, $1,000, and then 50K is going to be 5%, but $2,500. 100K, 3%, 3,000, and then 1 million. Here at 1 million, I would go up percentage wise, because 10K is kind of small to be playing with $1 million. I personally play with around 100 and 150, and my account is a little bit lower than that, which I shouldn't be playing too much of that. I should be playing with like this 2%. I should only be going with about 10% of my account, if that. Now to the next, which is going to be explaining to you exactly why it's important to limit your losses, and this will show you exactly why it's crucial to follow the rule I'm about to teach you. It'll make a world of difference. Here you can see 10% loss will take 11.1% to break even off of that 10% loss. You have to make 11.1% profit. Like if you went in with your full account and lost 10%, you would have to make 11.1% just to break even. And it gets bigger over time. As you can see here, 20% is going to be 25%. 50% is going to be 100%. And all the way down to 90%, that's 900%. Let's be honest, we don't want to be trading. That's going to take us a lot of trades to make that 900% back, and we don't want to be doing that, correct? And then right here it says, did your financial advisor teach you this? No, because you're still in the trade, and it will come back. He's saying that because a lot of people in the trade world will, and especially if you go to a stockbroker, they most time will not pull your money out for you. You have to ask them to. And most people in the stock market, why they lose their accounts, is because they don't cut their losses. They have the expectation of it coming back, which one thing that you're going to learn is the market is always correct. So don't just have the thought that it will always come back, because the majority of the time it will not go back. So keep that in mind. And you do not, 50% loss is 100% rate. You're going to have to make 100% of your money back just to break even. That's a lot. That's a big percentage of your account. That's a lot of trades. That's 4 to 5 profitable trades without a single loss. And it stacks up over time. So keep that in mind as well. But now I'm going over to Thinkorswim to explain to you how to make a correct stop out rather than a bad stop out. And this is the rule that I'm going to be showing you on exactly how I could win lose 3 trades and still make 1 profitable trade and become out profitable side. All right, so in this video, in this exact example, this is gonna be the good example. As you can see, we have 1, 2, 3, and we're about to be on our 4th bounce. I told them I called it out because it's on the top of a moving average and it was pushing up. It really wasn't showing a negative sign until I called it out around 10 o'clock and it pushed back down around 1 to 2 o'clock, so we didn't know about that information. Kind of my bad on that call. We should have waited a little bit longer for a better entry point. But nevertheless, the stop loss is so little that there was no reason not to take this trade, and you'll see here in a second. So let's see here. So we got 1, 2, 3, 4, 5. This would be the 5th bounce. As you see, hit the trend line there, hit it there, had a little bit of anomaly there, hit it there, and essentially hit it there. Now, just to put things into perspective, I called this trade out today, which is going to be the Thursday, the 30th of January. I got in it yesterday at the close, like at the very top. This is going to be a 31-cent move, 0.41% move from yesterday. I'm only down 4%, which is very little compared to what the trade I'm about to show you here in a little bit, which is, believe it or not, some people took this trade. I mean, they made profit, but it was really risky on their part because there was no way to know if it's going to pull back or not. And that's exactly what stop losses are for. It gives the stock a chance to pull back without you selling out and worrying about losing so much money, which is very crucial. So, I'll explain this to you. Rule is you want to have your stop loss to be 10% less of a loss away from a major pivoting point, rather that be like this to where the previous low, or a moving average, which is what I used in this example, or in a trend line as well. For today's trade, yesterday's trade, I used this moving average, and it was 4% loss, so I just took it already. Now, for the Discord group, which I'll link in the description, where we do daily signals for swing and day trades, join that if you want to follow my trades. So far, this week alone, I have called 5 trades out, and this is the 5th trade. So we aren't out of it yet because it's a swing trade, but the other 4 were 15% plus profit each trade, and I called those out for everyone in the Discord. So I'll link it in the description. Anyways, as you can see here, we have I was in here, but I called it out this day. So this day I used the moving average as a kind of like a stop out, but I mean the stop out is also so little all the way to the trend line, which is gonna be this stop out, because that's a major pivoting point. As you can see here, it's only gone below it once out of 1, 2, 3, 4 actually right here, 4. So 25%, 75% of the time, it's never been below this line ever since it's established this trend. So, like I said, a 0.41%, I am down 4%, and now we go all the way to the bottom here, 0.6%. That's a 6% loss for the 6 stock. And this is that percentage sign up here, right next to my mouse, where it says 0.69%. That doesn't mean it's exactly 0.7% of a gain in this instance because it's going up. It depends on exactly what stock it is and exactly what call you have. But for my call, it's a 4% loss, and down here will be around a 6% loss, around there. So for the people I called out today, I told them to buy here. I think it was around here. So say 76.8. We'll use that as an example. Anyways, 76.8. This is going to be around the 76.43-ish is going to be our stop out, because that's really ideal where you want to sell out, because it still gives the stock a room to break your stop loss or where its pivoting point is and still pull back up. You want to give it room to do that. You don't want it to just be, let's say this moving average. Let's say the moving average was 10%. I would still be in this stock. Well, right down here, I wouldn't be in it. If this was like 15 to 20% loss, I wouldn't be in it. But if let's just say this didn't happen, and I'm down, let's say this was 10% loss, let's say I'm down 12% right here, I would still hold till the next day to see what it does the next day, unless you feel like it's risky. Now, if it's if you wait till the next day and it opens negative or kind of sideways and it's starting to push down, then sell out, because that's showing that it's not going. The bulls aren't wanting to take over and push it back up. So you can kind of give it a lenience room, and that's going to allow it to at least give it a chance to pull back and let the bulls take over. Or if you're doing a put, that's going to allow the bears to take over. Always allow that to be the opportunity. Don't just sell out as soon as it breaks your point. Give it some time to pull back. Now let me explain this exactly in detail. So as you can see, around 76.42, just a little bit below our trend line, which is a major pivoting point. As you can see, in the past, it's only barely broken it by one time. And that's honestly an anomaly for this exact trend, actually. So around 76.4, we'll just use that as an example. And we'll draw, and around 70.8, that's a 5% loss. That's very small compared to what other people I have been seeing taking, which is 60 to 70% loss. I'm sure they would take countless trades of a 5% loss rather than blowing their account up in one trade. See how this is going to work? This allows you to have a 5% to 10% loss every single trade for 3 trades in a row. Make one good trade that's a 30% profit and still be profitable. Not even break even, profitable. That's a big difference to compare to, as we can see around here, where a 10% or actually a 50% loss is going to be a 100% ROI just to break even. That kind of just allows you to make a multiple trades and take losses and still become profitable. Now that doesn't make sense. Like I said, there's the link to the Discord in the group. Down in the description. Just message me through that Discord, and I'll be more than glad to help you. Now I'm gonna show you a bad example. Tesla. As you can see, we have one. Did it bounce down here? We have 1, 2, 3. So 3 bounces. It's a established trend. But let's just say this is the 4th bounce. This is an example, because this is way too much of a stop out. Last pivoting point is going to be either a little bit below this trend line. This moving average can be a pivoting point, or its previous low of its previous, like let's say here, see how it's pushing down here and it bounces exactly at this open. Same here, it pushes down here and bounces at this open. And here's a better example: it pushes up, pulls back, it closes that day, and it opens up. So right here, down here would be your pivoting point. But for this example, it's red. Pivoting point is to be at 493.95, and it pushed up that day. But let's just say you didn't take that trade that day, or you could have up to here where it says 2.19%, and that's $10. So that's going to be well above a 80% loss, well above 80%. So keep that in mind. That's significantly higher than what I just showed you. But if you took this trade yesterday or on open, even if you let it push down a little bit and saw it pushing back up, that's still a over 50% loss. And as you can see here, 50% loss of that initial investment, you can make 100% of that back. So keep that in mind. So let me go back to the chart. So as you can see here, this is why you need to keep your stop losses small, and I'll go back to here one more last time to explain it. Pivoting point down here. It's actually a little bit low, actually, right there. Okay. Look at around 76.8 is what I said. 0.4% or 31 cents. That's very small compared to that Tesla play I just showed you. And that falls for any stock, and you can use that for any stock or ETF, cryptocurrency, forex, anything you can do. Go percentage wise, and either you can find a price value, but majority of traders are going to do percentages rather than a price level, like $100 loss. Instead of doing that, they'll do percentage wise. It's just better to keep track and actually understand rather than price level. So hopefully that helps. If not, like I said, or if you need further explanation, just message me on Discord, and I'll be more than glad to help you. Other than that, that's gonna be it for this video. So make sure you like and comment anything that you would like for me to cover in the future, and subscribe. Until then, I'll see you in the next video.